Very good evening. So in the today's session we are going to start with the prime discussion on the concept of derivatives, where we are going to start with derivative options. Yesterday's session just I gave you introduction to as to how the securities market has started in India and how the evolution of stock markets happened, how growth prospects India has seen. So technically more about the securities market and the growth of Indian economy we have seen in the last class. If to be very frank, now great discussion of made on the derivative options as an introduction. So in the today's session we are going to start with the derivative options effectively. Okay. So please see the screen once. First, yesterday I told you these discussions, all these things we have written. So effectively the first class of derivatives starts today. Yesterday only I told you na evolution of stock markets, how they started, that only we discussed more. So today we are going to start introduction to the concept of derivatives. First thing, when you see a meaning of derivative in any book, they will give a clear meaning saying that derivative is an instrument. It's a piece of paper type which derives the value from the value of its underlying asset. Means one thing is clear. Derivative is not a instrument of its own. Name lone clear. Derivative means it is derived. It is not having its own value. Its value will be taken from that's all. So its value will be taken from the underlying asset. That underlying asset may be sometimes a share, it may be commodity, it may be real estate property, anything. In the new syllabus brought by the institute with regard to AFM, okay, they have brought new concepts where derivative instruments can be applied not just on the stocks, they can also apply the derivatives concept on real estate market, electricity, weather derivatives, etc. Yes. Am I clear? Shift to this side because total focus is shifting here, that's why. So the point is, whenever I say derivative, it is a derived instrument. Means what? Its value is derived from another asset. It's not an asset on its own. It is an asset which derives its value from the value of its underlying asset. Simply to tell, what is a share if I ask? What we will tell? Value of a share is present value of its future cash flows. But options and futures don't have like that. Their cash flows are not dependent on them. Their cash flows are dependent on underlying asset. Therefore, understanding the derivative instruments has become a challenge because it is not just understanding an instrument, it is to understand two instruments. Number one, the derived instrument. Number two, underlying instrument. Both are to be understood at the same time in order to have a good grip over the concept called as derivatives. In these derivatives, we are going to start today with derivative options. Name lone very clear. It is an option contract. May be there, may not be there. Execution may be there, may not be there. Meaning I will tell you. Why anyone has to enter into options contract? A person will be entering into options contract for three purposes. I have written there. The three purposes are speculation, arbitration, hedging. Speculation, arbitration, hedging. What a speculator does? Speculator will take a position in one market, opening his exposure in one market, maybe ended up with a gain or maybe ended up with a loss. Anything can happen. For example, how it look like? I will enter into a risky zone. Maybe I can reach that risk and I can get the return, or I can reach the risk and I can also get a loss. Yes. Are you understanding or not? It is like entering into CA. Technically, it is like entering into CA. It is a risky venture. We know that it is risky. But with what leap of faith you entered into CA, that we will clear it. So we are all speculators. But that speculation is covered by a hard work. But their hard work I can't do now. Invested in a stock, what hard work I can do? More speculative. This is also speculative trade. So we will enter into CA with a expectation or a forecast that we will qualify and become a chartered accountant. Very risky venture. Are you understanding or not? Now listen carefully. I entered into CA. I may pass I may not pass. Both can happen. It's a speculative deal. Okay, but it's not like an open speculation like market, but it's a speculation dependent on our performance. But it's speculative. May be there, may not be there. May pass, may not pass. Anything can happen. There is no guaranteed pass here. So it is speculative. Second, I entered into CA. I came to know that institute has lost its standards. Example, it is not giving proper standards in the question paper. Easily they are giving. Examinations are imperfect. This is a time to pass CA. I jumped into that as a direct entry to Inter. Inter easily they have given 35-40% they have given. I passed. I entered into article 2 years like dummy I have done. After that immediately I jumped to final. Papers came amazingly easy. I passed and I went out. This happened for 2-3 years. In the 2-3 years I am there. Seriously, this happened in 2010 and 11 and 12 and 13. CA Institute has given highest pass percentage. 39% they have given for CA final. 2013, 2010, 2011. At that time, the easy phase of CA people have seen. So technically to understand at that time, Inter la 35-38, final la 36-37 they have given. Okay, at that time only all these chartered accountants came. So a bunch of chartered accountants were released at that time. So my main point to explain, there is an imperfection in the institute. Taking advantage out of that imperfection is called as arbitrage. Arbitrage is riskless gain. Arbitrage is riskless. When you see in the market point of view, I entered into the market. Okay, I entered into the market. I calculated the price of the share, how much it should be. Okay, it is 100 rupee. In the market I have seen, it is 120. Market there is a perfection or imperfection. Imperfection is there and that imperfection is not permanent. It's temporary only. Immediately I will jump into the market, I will make a gain. Called as what? Arbitration. More about arbitration we will see when we start with the chapter. Very, very important is hedgers, also called as hedging. Listen, I entered into CA. Question papers are coming up bouncers. Okay, one attempt I have written, but I couldn't get through. Immediately, this market I already entered. CL I put one leg. This leg is becoming very much shaky because I couldn't qualify this properly. Okay. Now immediately to reduce this risk, I entered into BCom and CMA. Why? At least in the meanwhile I can complete these two simultaneously. That's called as a hedging. Hedging is the risk reduction strategy. It is a risk reduction strategy. If I sit only in CA and I couldn't qualify, life is over, age over, but this is not getting completed. In the meanwhile, at least if you enroll for other courses, certificate will come on hand. That's called as a hedging. Like that in the markets also people do the hedging strategy. Hedging is a concept where they will first enter into one market. That one market is becoming very much volatile. Immediately to secure themselves, they will enter into another safe market and secure their cash flows. Like this if I tell, no one will understand, I know. But we have to see the numbers and then only you can get the clarity. As of now, my intention is only to tell you the introduction to the options. Tell me how many players will be there in the market. 3 types of options players will be there. Number 1, speculative option trader, arbitrage option trader, hedger. Who is the hedger, who is a speculator, arbitrator? Everything we will see with the numbers clearly. Such that you will get a full clarity. Today's class only we will see. We will see both hedger, speculator and even arbitrator we don't see today. Speculator and hedger we will see today. Clear? Huh? So how options can be used as a tool for speculation, tool for hedging, both of them we will see. Clear? And you will get a great deal of conceptual clarity where from today whenever you see in the news channel, option trading etc., you will get a clarity, okay, what is happening there. Okay, so that is a point. So, as per general meaning, derivative is an instrument which derives its value from value of its underlying asset called as share. It is a tradable stock. Like a share, derivative is also a stock. Under what it is a stock? Under Securities Contract Regulation Act. Stock definition is there. Security definition actually. In that security, first one will be shares, scrips, bonds, debentures, debenture stock and other marketable securities. Clause B they will write clearly derivatives. Means derivative is also a security within the meaning of the Securities Contract Regulation Act. Listening? See there. Derivatives are of two types. There are two types of derivatives in India. Not India, throughout the world there are two types. Number one, options. Number two, futures. As I said, when I say derivative options, don't misunderstand. Only options is a chapter. I told you again, I am writing today. Listen carefully. Derivative is a hell a lot of concepts are there. First one, options. Second one, futures, swaps, or swaps I will write later, currency options, currency futures. Now currency swaps, interest rate swaps is different, currency swaps is different. Swaps, after that IRRM, interest rate risk management, FRA, forward rate agreement, interest rate swaps. What is that? Interest rate swaps. Electricity derivatives. Weather derivatives. Real options. Greeks. If all these are completed, then one can say that I completed derivatives chapter in the syllabus. Because new syllabus they have given so many of these concepts. So one should have a clarity on real options, derivative Greeks, everything we need to have a clarity. But one thing I can tell, to understand currency options, to understand currency futures, to understand real options, to understand option Greeks, okay, to understand option weather derivatives and electricity derivatives, and to understand the forward rate agreements using interest rate options, interest rate futures, for all the ticked portions, okay, basics are these two chapters. Without understanding options, how can you do currency options, interest rate options, etc.? Are you understanding or not? So to do that, first you need to have a clarity on what? Options you should have a clarity. Am I clear? And moreover in exams, these two chapters are having more weightage than these. Derivative segment, this totally come for 20 to 25 marks in exam. In this 20, 10 marks will come from first two chapters. 10 to 12 marks will come from first two. Options 6 marks question will come, futures 6 marks question will come. After that, 1 8 marks question will come from currency options or currency futures. 1 8 marks question will come from the IRRM and swaps. Okay, one question will come from all the other remaining areas. Understood? So therefore, huge area, but questions are very much high. Marks are very less. Means 20 marks only will come. You are seeing 20, but for the 20, how much effort we need to put? This full month we will do only this chapter. Understood or not? This full month we will do only this. There are so many concepts will be there. Yeah? If you read and leave, chapter will be completed very fast. But it will take minimum 20 days to complete all this. 20-25 days it will take. At least 60 hours we need to spend on this. That quality time if you spend on this particular area, pakka, no doubt will come once you complete the derivative options and futures. Okay. So for that, today is the first milestone to start with that. So up to here, everyone understood the concept clearly. Simple, I told you what I said, I will repeat. Derivative is not a separate asset on itself. It is a derivative instrument, means it is derived from another asset. That another asset is called as underlying asset. That underlying asset can be a share, debenture, real estate, commodity, interest rates, anything it can be. Yes. Listening everyone? Okay. So the derivative will create its value from the value of its underlying asset. Underlying asset is powerful. Options are powerful. Underlying assets are falling down. Options also will be weak. Are you understanding or not? If the business is not growing, share price will fall. Options will not grow. Option is a derivative. It will react as the stock is reacting. Stock falling down, options also will fall. Stock rising, options also will rise. Yes, listening everyone? So that's the point. So unlike shares, derivatives is not meant for investment. This is important. Listen carefully. Derivative is not an instrument for investment. Derivative is not a instrument for investment. Why it is not an instrument for investment? Because derivatives has a expiry. Derivatives have a expiry. Can I purchase the shares of TCS and hold for 10 years?
Yes.
Hold for 10 years or not? Yes. But you can't purchase a derivative option and hold it for 10 years because life will be expired in another 4-5 months.
Yes.
That means the intention of option is either speculation intraday, either speculation intraday or hedging interday, but a time frame is there for investment and disposal. A person buying the share is worried about falling prices. Listening, a person buying a share is worried about falling in prices. A person who sold today is worried about rise in prices. Okay, to counter that rise in fall in prices, we enter into options market. How? We will see in the chapter. That means we are talking about short term or long term. Short term we are talking. 1 year beyond also it will not go. Means everything is short term. So options is not for investment sake. No fool in the world will invest in options. Are you understanding? I will give you another example here. Common sense. You entered into the market today. You purchase shares of TCS. You purchase shares of TCS to hold it for 5 years. To hold it for? When you wanted to hold it for 5 years, why daily prices are bothered you? Why you are bothered about daily prices? If your intention is to buy today and sell after 10 days, every day you will see the market and whether it is rising or falling, you will be worried about. If your intention is to hold it for 5 years, why you are bothered about daily fall and rise in prices? You will invest and you will sleep, that's all over. You will forget about it. Understood or not? In my portfolio today, around for 10 lakhs or 12 lakhs, I have solid investment made. Okay, I invested 2.5 years back. I invested 12 lakh or 12.5. Now it is at 19 or 28 is running now. Okay, I wanted to hold it for another 4-5 years. I will dispose once I reach 30. Are you understanding or not? That's all. I don't even watch what is happening to those stocks on daily basis. Yearly once I need to prepare my income tax return. At that time I will see. Are you understanding or not? Yearly income tax return we need to file. At that, not to report in the statement. See, now if it is crossing 20 lakhs like that, income tax return we have to show them. Though there is no capital gain, we have to show the investments. Balance sheet I will prepare.
Yes,
Balance sheet I have to prepare or not? I can't go by presumptive income.
Yes,
Chartered accountants do. Why presumptive income sections came in Income Tax Act? If you can't prepare books of accounts, you go by. Chartered accountant not preparing books means thua. You are a CA, you can't prepare your own books. That section came for whom? ADA. Those who can't, who are professional. Doctor is there. Doctor is there, a small doctor. His income is 30 lakh, 35 lakhs per annum. What grade books they will maintain? For them, since they can't maintain proper books of account, you are a CA. 10 rupees also you should maintain books by logic. So chartered accountant should never go by presumptive taxation. If they are going, they are on a wrong track. You should prepare your books, you should get it audited. You only audit it, if not by others. You have to prepare now. At that time I will see at what prices they are trading to show in the balance sheet. So for that purposes, except for that purposes, I don't need to see them. But I know somewhere around 20 or 21 or now it is rolling on. Invested 2.5 years back, almost 20, COVID time when I invested. COVID time I have a tense situation, therefore I invested 12 lakhs or 13 lakhs at that time. Now it became 21. 9 lakhs hike means it's a great hike or not? That 13 definitely will go to 30, 35 by 20. Elections conducted. Elections will be completed in 2024. Government will come into power. Jai, it will rise. It will rise very high. At that time I will sell them. So, now the conclusion. If really your intention is to buy today and sell later after 5 years, why you are bothered about daily prices sharing? Prices will rise, prices will fall. Overall there will be increase only. Are you understanding or not? That's all, answer over. So for you options will not help. Options will help whom? I bought, I have to sell, prices are falling. Options will help you. I sold, I wanted to buy back, but prices are rising. Options will help you. Today I will buy and today I will sell. Options will help you.
Yes, sir.
Are you understanding or not? And then when you are investing for 5 years, why options for you? Are you understanding? So that's the point. So therefore, unlike shares, derivatives is not meant for investment. It is for above said three purposes. Here, what is the first one?
Speculation.
Second one?
Arbitration.
Third one?
Hedging.
Where is investing here? It's not there. There is a fourth player also. Investor, he is not there.
Yes.
Are you understanding or not? What is the first one?
Speculation.
Speculation means what? Intraday is a speculation.
Yes.
Second one?
Arbitration.
Imperfection. Next one?
Hedging.
Risk coverage. Where is investor here? Understood the point clearly? So, derivatives are not meant for investment purposes. Derivatives are meant for speculation or arbitration or hedging. Shall we continue? Last one. Derivatives can also take the shape of money markets. Means derivatives need not be always in the form of stock markets. Sometimes derivatives also can take the shape of money market. Means in the banking market also derivatives will involve. Those areas only we call as interest rate risk management and interest rate swap. So tell me, derivatives enters into which market? Stock market, currency market, money market. In all markets derivatives are there today. In the real estate market it went.
Yes.
In the electricity market it went. So which is more important instrument in the world today? Derivatives. Clear or not everyone? That's all. So, yes.
How will you present in balance sheet if you are trading options?
Hmm?
If you have bought options,
Hmm.
how will you present in the balance sheet?
Options will not be shown like that. It is a fair value to P&L. Yes, Ind AS 107, 109 will be there. Na? Fair value to P&L, it will be shown as an expense only because option you will pay premium only today.
Yes.
Real share you don't buy.
Yes.
What you paid?
Only the
Premium. Premium is an expense. It's a fair value through P&L. In P&L you will show it as an expense. Okay, when you buy the share, it's an investment.
Okay.
That's all.
Thank you.
So, introduction, concept of derivative. Everyone understood the basics? So, derivative is a separate instrument or derived instrument.
Derived.
It derives its value from the underlying asset's value. What is underlying asset? Share is an underlying asset. Real estate is an underlying asset. Banking, money market is an underlying asset. Interest is an underlying asset. Electricity is an underlying asset. Weather is an underlying asset. Agriculture is an underlying asset. Commodity is an underlying asset. Like these underlying assets will be there. On that, derivative will be deriving its value. Clear? Underlying asset gains value, derivative gain value. Underlying asset falls the value, this also will fall. So, with this, we first completed introduction to the concept of derivative. Next. Very, very important introduction. Options market. We are not starting with the futures first. We are starting with the
Options.
futures is understood if you complete options. Futures is less complicated than options. Options is very, very complicated area. Okay. Futures is very easy. Once you complete options, first you will be having a fine-tuned wavelength. After that, futures will be very easy. But options are not like that. Options concept is very, very complicated because there are a lot of instruments involved in the options market. Okay. Why it is so complicated? Let me explain once we understand the concept. See here. When I say option is a privilege. Option is a privilege. Privilege means what? You may take, you may not take. Or you know, discretion. You may take the discretion, you may not take a discretion. Understood? So, options market la, options to both the parties, so only one party is a question now. For example, two parties are there, buyer and a seller. Buyer and a seller. I will give you one example. A and B entered into a contract. A is a buyer, B is a seller. A promised to buy. From B a share at rupees 100. This promise is an optional one. Means what? I may buy, I may not buy. Listening? Okay. Or he made an option to buy a share. Now tell me, if I buy, what B has to do? Answer, sell. That means mine is a promise to buy, yours is a promise to sell. Yours is a promise to sell. Okay. So I locked myself at what price? 100 ki mandatory option? Option. I may buy, I may not buy. You tell me, this price is 100. I will take 3 examples. Market la price became 90, market la price became 100, market la price became 110. You answer, I will listen. Tell me, market la what is the price on that day? You said that you will buy after 1 month, yeah? Yes. Tell me, how many parties are there?
2 parties.
Everyone?
2 parties.
2 parties. Who are they? A and B. A promised to buy a sell. Buy. B?
Sell.
It is an option promise only, not mandatory, executable. It's an optional promise. Okay. Tell me, at what price?
100 rupees.
Today na after 1 month? Contract is entered today na after 1 month? Today. Contract entered today, but execution will be done in future. Listening? That's called as a forward transaction. What transaction? Forward transaction. Okay. Now what happened is, on the date, price may be 90, price may be 100, price may be 110 also. Now you tell me, I will listen. If the price is 90, if the price is 90, where it is 90? With you or in the market? In the market. Tell me, it is better for me, from my side you tell me, from a buyer point of view, it is better to buy with you or it is better to buy with the market? If I have to buy with you, at what price?
100.
But if I buy in the market?
90.
Now tell me, I will exercise, I will reject.
Reject.
I will reject and I will buy in the market at how much? 90. Listening? Second case, both are indifferent.
Yes.
Both are indifferent. Third case, you tell me, very important. Market law how much? 110. Listening? Now tell me, with you I can buy at how much?
100.
Answer? 100. So, I will buy, I will reject, I will accept, and buy at how much? 100. Up to your understood? Reverse you think. First situation, how much is the price in the market? First situation, how much is the price in the market? 90 is the price in the market. I blocked it, what rate? 100. Price in the market? 90. Third case, what is the price in the market? What is the price in the market? 110. You blocked it, what rate? 100. Listening? Now tell me, I will be buying in the market, I will be coming to you. I will be coming to you, correct? Now you tell that it's an option, I will not sell you. Listening? I said that it's an option. First situation, I am not exercising the option. Third situation, I am exercising the option. I say that I am exercising to buy, sell me. You said that you are exercising that it's an option to me, I am exercising not to sell.
Yes.
Listening? Then whenever I wanted to buy, you will not sell. Whenever you wanted to sell, I will not buy. Then where the contracts will be executed? Option is not option to both the parties. It is option to one party, obligation to another. Option to one party, obligation to another. To whom it is an option, to whom it is an obligation is the subject matter of discussion in the first day of the class. Listening or not? Or else it's a worst situation, yeah. Whenever I try to buy from you, you will tell that, Abba, I have to buy at 110 and I have to sell to you at 100. I will not exercise this option, I am lapsing. First situation. Which one? First situation. I can buy in the market at how much? 90. Then I will tell that I am lapsing and I will go out.
Yes.
Are you understanding or not? Then he will tell that, hey, how can you do like that? Buy from me. He can't tell like that. So, it is not option to both of them. It is an option to one party, obligation to another party. To whom it is an option, to whom it is an obligation is the subject matter of our discussion in the first part. Shall we continue? So, in pure terms, option is a privilege which is sold by one party and bought by another. It is an obligation to one party and an option to another. Options can work on anything, namely stocks, currencies, interest, commodities, etc. There are two types of options. Name them. Number one, call option. Number two, put option. Meaning everything we will discuss in the today's class. You have written the notes on this? No. Please write down this. Understanding options market. Write the notes. Understanding options market. Completed? So, now we are moving on to understanding the concept of options contract. See here. See, let me first explain how they work, the mechanics of options market. Once I explain this, I will explain for both the call option as well as the put option. Both I will explain such that you can understand them easily. See there, in one example I will explain both. First, A and B. A entered into contract with B. Arrow marks important. A entered into contract with B that he may buy 1,000 shares of TCS at the rate of 3,500 per share on 31st December 2023. Okay? 31st December 2020. This is the contract. Tell me, who said that he may buy? A. He is not telling that definitely I will buy. He is telling I may buy. Chance is there, I may buy. Probable. I may buy 100,000 shares of TCS at 3,500 per share on 31/12/2023. A promised to, A said that I may buy from you. B also said that okay, I will sell. I will sell. May is only for the A. May is not for B. Listening? So this is a contract. Now, A is called as popularly, now the notations come, please carefully listen. A is called as option holder. A is called as a option, not shareholder. As of now, I am not buying and selling the share. Today, I am entering into which market? F&O market. Listen, when you open the demat account, trading account, not demat account, sorry, trading account if you open, segments will be there. Segment number 1, stock segment, also called as a cash segment. Second one, F&O segment, in that futures and options are traded. Yes. Listening? Sir, seriously, I will tell you this way, you can understand. I wanted to buy vegetables. Which market you should go? Stationary market. Vegetable market you should go, kada? I am asking seriously only. You wanted to buy vegetables. Which market you need to go? Vegetable market you need to go. I wanted to buy fish. Which market you need to go? That's all. You should not go to stationary market and ask for a fish. Same. You are trading on options means why you are going to stock market and checking whether options are available? There is a separate market segment for that called as F&O segment. Which segment? F&O segment. Okay. So, in that F&O segment, I am opting for option segment. In that options TCS, in that I am entering into another option to buy. Clear? A is a option holder. It is option holder. B is a option writer. B is a option writer. Obligation is to the writer, option is to the holder. Always. Holders are having option. Next, other person. Writers are having obligation. Writers are having obligation. Always. Holders have option. Writers have obligation. So tell me, who is having an obligation to sell? Writer. Who is having an option to buy? Holder. Okay, na? He is called as an option holder. He is called as an option writer. Buy is called as long position. Is called as long position. Next, may is a option. 1,000 shares of TCS, underlying asset 3,500, very important, called as strike price or exercise price. Strike price or exercise price. This is called as maturity date. This is called as a maturity date. Tell me, how many parties are there?
Two parties.
Two parties. What is the first one?
Option holder A.
Huh?
Option holder A.
Option holder. B. Option writer. Meanings I will tell you later. Just notionally prima facie read the words. First get acquainted to the words and phrases. First every market has their own parties. First know them. First A is called as a option holder. B is called as a option writer. May is a option. Buy is a long position. TCS is the underlying asset. 3,500 is strike price. Strike, S-T-R-I-K-E, strike. Strike price or exercise price. Okay. Date, 31/12/2023 is called as maturity date. That is the date on which you are going to buy or sell. Everyone understood the words clearly? Yeah? Everyone understood? Now, I will explain what happens. Strike price, actual price, action by call holder. This contract totally is called as call option. Which option? Call option. Sir, how to know whether it is a call or put? You should see from holder point of view. Holder is buying or selling? Option A, buy or sell? Option to buy is called as a call. Option to sell is called as a put. Listen, I wanted to buy a share. I wanted to buy a share. Okay, I will keep the share. I will take the share. I will keep the share and sell. I will take the share. I will take means I will call you and take. When I have the share, I will put and sell. Therefore, sell ki put, buy ki call.
Yes, sir.
Understood the concept or not? That's how the name came. So tell me, what are the two types of options?
Call option.
Call option, put here, from whose point of view you should see?
Buyer.
Buyer point of view you should see. Sorry, holder point of view you should see. Holder is buying, which option? Call. Holder is selling, which option? Put. Here, which option?
Call.
Call. Okay. This is a standard pro forma for entire chapter. Strike price. Tell me, at what price I blocked myself?
3,500.
Three situations I have taken. AP can be 3,600, 3,500, 3,400. Three situations I have taken. You use common sense and tell me, what is the price at which you locked yourself?
3,500.
In the market on expiry date on 31/12/23, these are the actual prices. Tell me, in the market, what is the actual price?
3,600.
Now tell me, you will buy in the market, you will buy it with the writer.
Buy with the writer.
Answer.
Buy with the writer.
Means you will exercise the labs, exercise and buy with the writer. Understood the point? Second example. This is indifferent. This is indifferent. The concept I call is indifferent concept. Third one. Tell me, if you have to buy in the market, at what price you can buy?
3,400.
3,400. Now tell me, if you buy with the writer, at what price you should buy?
3,500.
Now like a fool, you will buy with him at 3,500 or you will buy in the market.
Buy in the market.
Then what you will tell to the writer? To the writer you should tell, I am lapsing. I am lapsing. Lapsing with whom? Writer. With the writer you lapse, go to the market and buy. Listening? Now tell me, from this what is the understanding you should get? My buying price of a share. My price of a share. At no cost, it will not go beyond 3,500. If the market price is 4,000, I will buy at 3,500. Market it is 3,000, I will buy at 3,000. In no case it will be more than 3,500. That's the greatness of option. Understood the concept clearly or not? Okay. So now tell me, when the market is at 3,600, what I am doing? I am coming to the writer and I am telling you I will buy with you. When markets are favorable to me, what I am doing? I am giving hand to the writer and I am going to the market and buy. It's a pakka use and throw concept.
Yes.
When you want me, you are coming to me. When you don't want, you are throwing me. Why I should become a use and throw instrument to you? For that I will charge an amount called as a premium. Or else you will use me and throw me. You are a use and throw fellow. Are you understanding or not? For that I will charge something. For using and throwing also I will ask money. Nothing will come free of cost in world. So I will ask money to use me and throw me. So therefore that money what you ask is called as a premium. But before going into that, answer my question clearly. How much is the strike price?
3,500.
Market is favorable or unfavorable? First case, unfavorable. You are coming and going to whom? Writer. You are telling the writer, please sell me. Now writer has an option or obligation. You are having an obligation, not an option. You have to buy at 3,600 and sell to me at 3,500.
Yes.
Listening, sir, if at all option is not there, I should buy it.
3,600.
But because you are there to save me, I am saving a risk of loss of how much? Answer. 100 rupees, my risk is saved or not? Like this, it went to 3,700. How much loss you are saving?
200.
3,800.
300.
4,000.
300.
500 rupees. Like that, who is saving my risk?
Writer.
Writer. Means my risk you are taking. Means my shock you are absorbing. Correct or not? My risk you are taking, yeah. Now tell me, in the world, one person's risk will be taken by another person. What is the name given to that contract? My life, I may die. You are taking the risk. My vehicle may commit accident. You are taking risk. What is the name of that contract? Insurance we call. What is the name of the contract? Insurance we call. Insurance ki what they will collect? That's why premium is collected here. That's why options have premium. Are you understanding or not? That's why what is having premium? Options. Just a minute, I will show you one point. See here once. I will show you one point for your clarity. See here. This is what? Appeal to whom? Securities Appellate Tribunal ka appeal. Okay, this is appeal case. Okay. When you will go to appeal to SAT under the SEBI Act, read appeal by aggrieved person. Aggrieved by whose orders? Aggrieved by the orders of SEBI. Assessing officer. Adjudicating officer under section 15. Next one is? Why IRDA is coming here? Because derivatives are governed by IRDA in India. Are you understanding or not? IRDA will take care of all derivative transactions because derivative is an insurance contract. That's why in the act also they have written like that. Students don't understand now what they will read. IRDA, they will read. Why IRDA? Because derivative contracts are proper insurance contracts. Therefore, they consider. That's why premium will be collected. Okay? Just a reference I am showing you. That's that you should not forget. Sir, okay, understood the concept clearly. Yeah? So, options is a proper insurance contract. So, now see the screen. What happened? This is also same. General examples only I changed here. Numbers I changed. But the pakka contract understood everyone. So therefore, how many parties will be there?
2.
Number 1,
Option holder.
option holder. Next one is a option writer. Option writer. Listen, one very, very important observation is there, which students are not properly making it. Listen. What a call option holder will do. What a call option holder will do. That's wrong. You should ask what. Okay, what call holder will do means you should ask with what. With option what he will do, with the share what he will do. Both you should know. Are you understanding or not? With the option. See here. Tell me, you are having a option to buy a share, sell a share. Buy a share, sell a share. How you are getting that option, yeah? How you are getting that option? Who gave you that right? That right is sold to you first. Writer has sold an insurance policy to you.
Yes.
Who sold?
Option writer.
Writer. Now tell me. There are 2 parties. Number 1 is holder. Number 2 is writer. But this is wrong. Writer, holder. He is a creator, yeah. He creates
The option.
option contract. Option.
Contract.
He will sell the option. You will buy the option. Tell me, call option holder is having what?
It's
Call option holder has option to buy the share. Has a option to buy the share. How that option you got? You bought it. You bought share, you bought option. First you bought option. Because of that option you are having a right to buy a share.
Yes.
Clear or not? Tell me, who will sell the policy?
Writer.
Who will sell the policy? Writer will sell the policy. You will buy the policy. You will buy the policy. Because of buying the policy, your risk is covered. Your risk is covered. Market la accident happened. Means prices are raised in the market. You buy with him. Market la no accident. You will buy in the market directly. Listening, you are doing buying activity of what first?
Option.
Option you have to buy first. So tell me, first you will get insurance policy. For example, you will get surrender value first, later you will pay premium. First you will pay premium and later you will get surrender value. That's all. Premium has to be paid first. Premium means insurance company is selling its policy, insurance holder is buying the policy. Same thing also here. Writer will be selling the option. Holder will be buying the option. You are buying what? You are buying a right to buy. You are buying a right to buy, option to buy. Listening or not, everyone? Tell me. Now you tell me. What writer will do initially? Buy a option, sell a option, sell a option. What holder will do? Buy a option. Now from holder point of view, tell. Since I have a buy an option, I bought an option, I will have obligation to buy a option to buy a. Answer. As a holder, I am having an option to buy a, obligation to buy a. Option to buy what? Buy a share. Option to buy a share. But if I opted to buy a share, it is a obligation to sell. It is an obligation to sell. Understood what I said? I repeat. No problem. I will repeat. There are 2 parties. Writer, holder. Who is the creator of the contract? Tell me what he will do with an option. What he will do with an option? Option will be sold by him. Option will be bought by him. Because of buying an option, holder will have a option to buy a share, obligation to buy a share. Option to buy. But if I opted really on that day, you are having a obligation to sell. So now tell me, what call holder will do with an option?
He will opt to buy.
What call holder will do with an option? First you should have clarity on these aspects, or else options chapter we need not prepare. Tell me, what call holder will do with an option? Buy. Option, buy. That's all. What call writer will do with an option? Sell. Again, call writer will sell option. Call holder will buy option. Over. One part. Future law. What will happen to the share? Let us see. Call holder will have an option to buy. Call writer will have obligation to sell. Listening everyone? So tell me first, what call holder will do with an option? Option I am telling means initially only. What call holder will do with an option? Buy. Again what option to buy? Buy, that's all. Option to buy will come in future to the share. Okay, again start from the beginning. What call holder will do with an option? Buy. What call writer will do with option? Sell. What call holder will do with a share in future?
Up to
Buy. Then it will become an obligation to sell. That's all. Understood the concept clearly? That clarity we should have. So, call writers always sell. What they will sell? Options they will sell. What they will sell? Options they will sell. Always holders will buy. Adi putta, kala, you forget. Holder will buy option, writer will sell option. What will happen to the share we should remember? Call holder will buy a share, put holder will sell a share. Share is different, option is different. One transaction happens in F&O segment, one transaction happens in share segment. Don't mix both of them, confusion will come, derivatives gone. Understood the point or not? Without having these clarities, if you do only, derivatives chapter becomes difficult. They don't understand half the way, they will go without clarity. Tomorrow just you see Jack, how it will be. Greek and Latin for him. Are you understanding or not? Not normal. Bheja fry. Brain fry. Say people don't understand. If you get absent to the introduction class of options, na gaya, goodbye. Over. Tata. So, because this is the main area which one has to understand and concentrate on what is happening to the option and what is happening to the share. So, summary. Writers will always sell the options. Writer will always sell the options. Holder will always buy the options. Remember this. Writers will always sell the options. Holders will always buy the options. Okay. After that, in the share market, depending on the type of instrument you are holding, you may buy or sell a share. Holder, call holder will buy a share, put holder will sell a share. When call holder buy a share, you have obligation to sell. When put holder sell a share, you are having an obligation to buy. Listening everyone? Same mirror image, let's reverse. It is a put option. See the put option now? Numbers and dates only will change. Are you understanding or not? See there. How many parties are there? Same, ditto, everything is same. How many parties are involved here? Who are they? A, B. A has a option to sell on what date? If the market is unfavorable. First tell me. A has promised to buy. Promised to buy. From whom?
B.
From whom? B. Now, A has promised because it's an obligation for A. Reverse the example totally. Parties also changed now. Previously A is buying. Now A is selling. Sorry, previously A bought as a option holder. Here A is buying as a put option holder, put option writer. Okay, let's see what is happening. Who is he? Answer. Who is he? B. So now what is happening? Let's see. Promised to buy. How many? 1,000 shares. Of what? TCS. Next. On maturity date of 31/8. At what price? 3,000. At how much? 3,000. A is promising to buy. B has a option to sell. Listening? For A it is an obligation or option? Obligation if I exercises the option.
Yes.
Listening? Now tell me. I will ask you a question. Same thing. SP, AP, action by the put holder now. Put holder will buy a seller. Not with option, share. He will buy a seller. Put holder will buy a share or sell a share. Call holder will buy a share. Put holder will sell a share. Are you understanding or not? When you are having a doubt on buying prices, you will enter into call. When you are having a doubt on selling prices, you will enter into put option. We are talking about call option or put option now. Put option. I am trying to sell a buyer. Sell. I locked myself at what price? Market it is 3,600, 3,500, 3,400. Answer all the three now. Tell me, in the market, at what rate you can sell? See there and tell, in the market at what rate you can sell? If you sell with the writer, at what rate you can sell? You will exercise a lapsa. Lapse with the writer.
Yes.
Lapse with the writer. Why?
Because
You are having a better option. Yeah, you can sell at 3,600. Lapse and sell in the market. Next, indifferent. Third situation, very important. If you sell in the market, at what price you can sell?
3,400.
But in the writer, you can sell at how much? Now you will exercise a lapse, exercise and sell to the writer. Writer has to buy.
Yes, sir.
Writer has to buy. So now tell me, put option concept everyone understood. Now think and answer. Slowly you answer. I will write. Put option. Writer, holder. What writer will do with option? What writer will do with the share? What holder will do with an option? What holder will do with the share? Please tell me all the four answers one by one. First tell me what writer will do with an option. What writer will do with an option first? What he will do? Sell. Whether call option or put option, he will be the seller of an option. What holder will do with an option?
Buy.
What he will do? Buy. Buy a option to sell. Buy a option to sell. Listening? Previous example of what he has done. Buy a option to buy. Here buy a option to sell. Listening? But buying a. Always remember, holder will buy the policy. Holder will buy the policy. Which policy? Option policy. By paying premium, that's all over. So tell me, what put holder is doing with an option? Buy. What call put writer will do with an option? Sell. Because of having this option, now market fluctuations happen. I am now risk free. Okay, now tell me, with a share, what a put holder will do? Put holder will do with an option. What he will do? I am having an option to buy, an option to sell. So I will sell. If I really opted to sell, you are having a obligation to buy. Understood the concept clearly or not? Answer, yeah? This is the situation, yeah. So now tell me. Option, share. Call holder, put holder. Call writer, put writer. What call holder will do with an option? With a share. Put holder with an option, with a share. Call writer with an option, with a share. Put writer with an option, with a share. If you can answer this table, full clarity. After that, no doubts will come. Tell me, think and answer, no problem. What call holder will do with an option?
Buy.
What put holder will do with an option? Answer, yeah. What put holder will do with an option? Buy. What call writer will do with an option? What call put writer will do with an option? Sell. Writers will always sell the options. Now think about the share. Call holder will have an option to
Buy this.
option or obligation?
Option.
Option to buy. Put holder will have a
Obligation.
option. Hey. Put holder will have a. Why you bought then? Put holder will have a option to sell. Call writer will have a obligation to sell. Put writer will have a obligation to buy. This you need to have a clarity. If 8 parties, if you have a clarity, then questions will have a clarity. So understood what I said? Understood up to here? So write down this. What call option holder will do with the share?
Buy.
What call holder will do with the share?
Buy.
Buy. Correct. What put writer will do with the share?
Sell.
Put writer will do with a share. Means put holder what he is doing you should know. Writer share position will be dependent on the holder. Holder buys na I will sell. Holder sell na I will buy. Put holder will. What he will do with the share? Put holder sell a share. Put writer will buy a share. So now tell me what call holder will do with the share?
Buy a share.
What call holder will do with the share? Buy a share. What put writer will do with the share? Buy a share. Both of them will buy. Then what is the difference? For one it is an option, for another it's an obligation. Put writer it is an obligation to buy. Call holder it is a option to buy. That's why I have written there clearly. Mental we are getting na. That's why options are said to be difficult, because 8 parties what they will do, you should have a clarity first. Once you revise 2-3 times, then you will remember them. Please write down this in the notes. At least in that way you will remember. Okay. Don't copy this. Only just write down up to writer. Or you do one thing. Write in this way. This is easy. I will write the pro forma. You fill the answers. Option share. Call holder, call writer. Put holder, put writer. Write down the answers. Think and answer.
In case of call writer, starting the premium will be more.
Premium
The
will be
amount of premium.
500 share ki premium will be 10 rupees, 12 rupees, 15 rupees like that.
Why he is taking that much risk?
That doubt everyone will get. Then call writer should become a beggar. But they will only win. Why also I will tell once we start. Premium will be very low amount. 500 rupees share na, it is somewhere around 18, 20 like that it will be. But what is the advantage we will discuss. Completed writing. Call holder will buy an option and buy a share. Call writer will sell an option, obligation to sell a share. Put holder will buy an option and sell a share. Put writer will sell an option having a obligation to buy if they sell. I have obligation to sell if they buy. That's all. If you have this clarity, chapter becomes easy. Copy down if you didn't. So with this, we completed introduction to how the options will work. Both call option as well as put option. In your notes, I have given this chart. Okay. Give one glance to it. Who will do share buying activity there? Out of all the transaction, who will do the share buying activity? No, share buying activity. Call holder will do, put writer also will do. What call holder is doing with the share?
Is buying.
Buying. What put writer is doing with the share? He is also buying. Both are buying only. But what is the difference between both? For a holder, it is an option to buy. For a writer, it is an obligation to buy. Who is selling the share?
The call writer and
Who is selling the share in both the cases?
call writer and put holder.
Who is selling a share in both the cases? Call writer is selling, put holder is also selling. But what is the difference between both of them? Put holder has an option to sell, call writer is having an obligation to sell. Remember this, one concept will be there called as a put call parity. What is the concept?
Put call writer.
In that concept again this will get touched there. The concept is dependent on this relation. Now I established a relation, two people do the same thing. What they do?
Sell or buy.
What they do, buying will be done by two people. Who are they? Call holder, put writer. Okay, call writer, put holder. Both of them will do the same activity. Okay, now that relation will have the meaning when we come to which concept? Put call parity equation. Are you understanding? Our mind will be blown at that time. Okay, that's why we established a relation between those two people. Okay, so that's the point. With this, we completed the basic understanding of how the call option and the put option works. Clear everyone? See the notes. Writers will always sell the options. Holder will always buys the option. But what they do with the share depends on the type of position they take. Whatever I discussed is in the notes. Okay. Why a writer has to take an obligation and what he will get in return, question will arise. Why writer has to do all these risky ventures? Yeah, he will receive a premium. Now one person asked a question now in the class. Why writer has to do like that? How much premium they will collect? Okay, I'll ask you. Insurance policy surrender value will be 1 crore. Policy per month will be 15,000. Where is per 3 months? Where is 15,000? Where is 1 crore? Now tell me. Insurance companies are wealthy. Insurers are wealthy. Sorry, insured is wealthy in India.
Insurance companies are.
Same. Writers are only wealthy. Do you know why? I will sell a premium of 20 rupees share to 1 lakh investors, 1 lakh people. 1 lakh into 20. How much I will get? 20 lakh. How many people will really exercise and buy with me? There may be 100 or 1000 will be there. I may spend 10 lakhs on that. But netly I am getting 10 lakhs gain. Are you understanding or not? That's how the option writers will make the profit. Sir, can you become a writer in the options market? Yes, you can take. I have done so many times as an option writer. It depends on, sir, market perception is the base for us. What is the base? Market perception. Market sentiments are our base. If you feel that the sentiment of the market is going down, market sentiments are going down. For example, I feel that market movement is in the downward side in the next coming 1.5 months. Okay, I will take writer position. Do you know why? Definitely you will lapse. If my imagination comes true, markets are falling, then you will buy in the market. Why you will come to me? I will take call writer position. Are you understanding or not? When the market, I percept that in the market, prices will fall. I will take writer position. Daily I will come into the market. Now with what intention you will come? Sir, market like everyone need not behave in the same way. Everyone have their own mental perception. You felt that prices will rise. What you will do? Yeah, prices will rise. I should lock myself at a price. You will lock at 100. I percept that it will fall to 90. As my imagination come true, it fell to 90. Now you will buy with me in the market. Market automatically premium is advantage for me. It depends on the perception. Okay. If writer has a bullish perception, holder will have a bearish perception. If writer has a bearish perception, holder will have a bullish perception. It percepted changes. We are thinking that option holder and option writer are entering into two mutual contracts. No, both are entering into two different mindsets. If I feel that prices are rising, why like a fool I will enter into call writing? Are you understanding or not? If I percept that markets will rise, like a fool, why I will enter into call option writing? If I write a call option, means I have an obligation to sell, correct? You have an option to buy. Markets are rising. My perception is markets will rise. If markets will rise, what will happen? If market will rise, what will happen? Automatically you will come to me on that day to buy. I have to buy at a higher price and sell to you. I am getting a gain or loss, sir? Then why I will enter into option writing? Listening, that's why there is a concept called as a spread positions. What position? Sir, institute sometimes will do certain dirty things in syllabus. They included entire options. Asal important option strategies. Okay, option strategies are important. Butterfly spread, condor spread, like that so many spreads are there. Bull spread, bear spread, condor spread, butterfly spread, horizontal spread, vertical spread, straddle, strangle, like that so many strategies are there. Asal those student has to learn. They didn't keep them in syllabus. Are you understanding or not? They didn't keep them in syllabus. And funniest part is it is there in CMA syllabus. Recently only I taught for CMA final. For them it is there. It's not there for CA. So I don't know why they will do such dirty things when they introduce in the syllabus, introduce everything. Mainly in the every day if you open the CNBC profit in option, they will discuss only about strategies. How to take a straddle strategy, how to take a strangle strategy, how to take a bull spread, how to take a bear spread, how to take a butterfly spread, how to take a vertical spread, how to take horizontal spread, how to take condor spread, butterfly spread, like that they will tell. So when, what position, do you know what is a spread? You will be both writer and a holder. Writer at one price, holder at another price. The fantastic concepts they are. Okay, but they didn't include that in the syllabus. Okay, sorry, okay, no problem. When it is not in the syllabus, don't expect me to teach also. We don't have that much time to tell about strategies. Okay, it takes minimum 4-5 classes again if you have to teach the strategy. But one point is clear. Writer, holder will have a common mindset, opposite mindsets. Opposite mindsets both will move. I am percepting fall, I will go for call writing. I am percepting rise, I will go for call holding. Or how can you tell I am percepting a fall in prices. Percepting fall in prices. You want to maximize your return. What you can do? You take call writing and put holding. Call writing and put holding. Call writing prices will fall. Prices will fall. Automatically what will happen when prices fall? That person will buy in the market. He will not come to you. You got premium. Correct? Bulk premiums you will receive. Listening? Markets are falling in the market, rising? Falling in the market. At a higher price you sell, which you already blocked as a put holder. Maximizing the gain. This is called as a condor spread. Taking same position in both the markets. Risk is also in the same way. When I say return is more, what is also more? Your perception reverse. On that day price, it was hiked. What will happen automatically? You are gone. As a writer, you will lose money. What you gain in the put holding market, you will lose in the call writing market because that fellow will come to you. Now what will happen? You will sell the share now, you have to sell the share, correct? You have to sell the share. First to sell the share, you should have a share now, you have to buy at a higher rate from him. Listening? So like that, it is always an opposite perception. Condor spreads are either extremely profitable or extremely loss making. Butterfly spread. Two options you will take at a middle price. One option as a call holder you will take at a higher price. One option at a lower price. Like that they will take. Like a butterfly it will look like. Center stretch la middle price ki you will take a writings. Upper stretch la holding, below stretch la holding. It's a variety concept. Put to call they will take. So we have to do with the numbers. It's a great concept, butterfly spread. They didn't include in the syllabus, but understood the nature and behavior. Both will not have a same perception. Okay. Next. So what they will charge?
Premium.
How to decide premium? For that only 4 strategies came, models came. First one, binomial model, risk neutral model, binomial tree model, Black-Scholes model. In that the most important in the worldwide is Black-Scholes. Exactly important is Black-Scholes. Why? Every information institute has to give. Standard normal table, logarithms, natural log tables, nonsense they have to give. And moreover, formula application only. Therefore, rarely question comes from Black-Scholes. Questions more will come from binomial risk neutral. Isn't it? Real life Black-Scholes. That's why even on the internet if you see Black-Scholes calculators are available. Black-Scholes calculator is available online. Binomial calculators will not be there. Black-Scholes calculators are there. Our exam question is there. Na? That information if you put in the calculator, direct answer. They will give the answer directly. 5 informations we need. Strike price. What?
Strike price.
Strike price. Actual price on that date, beginning date, AP.
Yes.
What is that?
Actual price.
Actual price on that date, AP. Strike price. Interest rates.
Yes.
Next one is the time of, for what, how many months you are opening that contract. Listening, standard deviation. If you know all these, you put the numbers there, done. 1 minute they will give full calculation. How much is the Black-Scholes price? Premium prices they will give there. So premium is scientifically calculated number. It's not a random number, whatever you want. That premium will be calculated using 4 models. What are those? Binomial model, risk neutral model, binomial tree approach, Black-Scholes model. Okay, read. It must be noted that options contract is a typical insurance contract where insurer will cover the probable or likely risk of the insured, and for doing that he charges a premium. Listening, everyone? Write down below. Payoff terminology. Write down. Open the notes. Write down in the notes, sir. Payoff terminology. From here the problems will start. What is the name of the concept? Payoff terminology. This table if you forget, gone. Exam like this table you have to remember. Literally mug up this table. What are all the columns? First one is SP. What is SP? Strike price or actual exercise price. Copy down this. Okay. So, next question is when one should exercise and when one should lapse. Okay. Formula wise you can mug up, but which I don't prefer anyway. First let us see. Tell me, you first tell. Call holder will buy. Call holder will buy when the market is favorable or unfavorable. Buy with the writer I am asking. With the option writer, when you will buy? When the market is unfavorable. If the market prices are low, what you will do? You will lapse and buy there. When you will buy? If the market prices are rising, then you will take the shelter through the writer. You will lapse when the market is falling. Reverse for the put holder. As a put holder, what you will do? When the markets are falling, you will sell with the writer. When the markets are rising, you will sell in the market. Correct? So, but how to tell that in the form of formula? Okay, exam our understanding is irrelevant for them. How great you are in understanding, you need to present in the paper or not. At that time, how to present our answers. See here. Call holder, put holder. SP, AP, action by call holder. SP, AP, action by put holder. You tell me, I will write. SP 100. 100 is the price which will change a locked price. Already we locked ourselves at 100. Okay. AP 110, 100, 90. 100, 100, 100. 110, 100, 90. Same prices. How put holder and call holder look like? Let us see. Okay. See there. Tell me. First point number 1. As a call holder, you have an option to buy at what price? 100. A share which is trading in the market at what rate?
110.
Tell me. You will buy or you will not buy or? Ade, you will exercise or lapse or? Exercise and buy at how much? 100. Understood the point clearly? Okay. Next. In exam, don't write this E-100. Just write E and leave. Actually, you should not write E. You should write exercise. For understanding in classroom, I am writing. Okay. Next. You may either exercise, you may either lapse. Anything you can do. Understood? You may either exercise, you may either lapse. Third situation, tell me. In the market, what is the price of the share? You have an option to buy at how much? 100. But in the market, you can buy only at 90. You will exercise and buy at 100. You will lapse and buy at 90. I will lapse and buy at 90. Understood the point? Don't write like this in exam. Exam, what you should write? Exercise or lapse, that's all. Don't write 90, 100, they will get confused. Understood? Classroom discussion, I am writing this. Okay. Tell me the next one. As a put holder, you have an option to buy or sell. You have an option to buy a share or sell a share. Sell a share. Okay. You have an option to sell a share, put holder. Tell me, you have an option to sell at what rate? 100. You have an option to sell at 100 if you exercise. But in the market, what is the price prevailing? 110. You will exercise a lapse. I will lapse and sell at how much? 110. Listening? Second case, it is again either exercise or lapse. Now tell me. I have an option to sell at how much? I have an option to sell at how much? 100. In the market, I can sell at what rate? 90. I will exercise a lapse, exercise and sell at how much? 100. Listening? Where call holder exercise, put holder lapses. Where the put holder exercise, call holder will lapse. Listening everyone in the class? This is the point here. Okay. So now tell me, as a formula you first tell me, when call holder will exercise. When call holder will exercise. Call holder will exercise if SP is less than AP. If SP is less than AP. When it is indifference, equals to AP. When he will lapse, SP greater than AP. Like that, tell me for the put option now. When put holder will exercise, put holder will exercise SP greater than AP. He will exercise. When he will lapse, SP is less than AP, he will lapse. Correct? SP less than AP. Now tell me, SP equal to AP, it is indifferent. Means when SP is less than AP, Call holder will exercise, put holder will lapse. Listening everyone in the class? Understood? So, this is how the notes will be. Read them. Read that. This is for call holder. Read the analysis also. SP is greater than or less than or greater than. Then what you will do? Exercise a lapse or lapse. SP 110, AP 100. What you will do? You will buy in the market. Okay? Understood all the three? Now read this. This is for which one? Put option. Understood? Okay, ba? Understood the concept clearly? Listen now. Not yet done. I will tell you more easy way to understand this. Don't mug up like this. SP greater than less than, you will definitely forget. Okay. Even I don't remember like that. Simple concept is, we will be locking API, SPI, which is in our hand. Strike price is in our hand. Yeah, actual price anyway we can't control that. So what is in your hand only you should compare. Okay, which you can't control, so forget about it. So SP only you remember. Tell me, call holder will buy a share or sell a share? Buy a seller. Put holder will?
Sell.
Now tell me, call holder will?
Buy.
You want to buy at a lower price or higher price? Therefore SP should be less than AP to exercise. Okay, SP should be lesser than AP to exercise. Tell the put holder now, as a put holder, what your locked price? Your locked price is what? SP. SP is your locked price. As a put holder, you will buy a seller. Sell. We want higher selling price or lower selling price or higher. Therefore, SP should be greater than AP to exercise. Answer over. That's all. Rather than remembering like this, SP greater than AP, less than AP, you will forget definitely one day. Now tell me, as a call holder, I want SP should be less than AP or more than AP. To exercise, SP should be less than AP or more than AP. Therefore, less than AP he will exercise here. As a put holder, you want maximized SP or minimized SP? maximized SP. Therefore, SP should be greater than AP in order to exercise. That's why SP greater than AP, he will exercise. That's all, answer over. So you need not even break your brain, you can easily understand this way. Are you all comfortable to the basics clearly? Everyone? Clear basics? With this, we completed the basics of the options chapter. Let us do 3 problems for today and leave. Okay? 3 problems. Hardly that will take 10 minutes to complete. Basics of options. Let us do 3 problems. Open the study material, open the hand notes once. In that I have given you questions. See there. Okay? Directly answer there itself. Page number 178. Come fast. Shall we? See there. Basics. From the following, find whether holder of a call option would exercise his right on the date of expiry date. Okay? First thing, holder of a call option means I am what? Call holder. I will have an option to buy, an option to sell, option to buy. Okay, now tell me. SP 90, AP 210. I will exercise a lapse. Just remember one point. SP should, I am a call holder, call writer. Call holder. My SP should be always less than, without all answer over. Tell me. First one, exercise or lapse? Exercise. Second one, lapse. Third one, exercise. Fourth one, exercise. Fifth one, exercise or lapse. Fifth one, lapse. Sixth, seventh one, lapse. Eighth one, exercise. Ninth one, exercise. 10th one, lapse. Understood how they behave? Now, same you do the put option now. I will also do, don't see the answers. You do on your own. First tell me, SP is a selling price or buying price for him? Selling or buying for a put holder? This is a put holder. Selling or buying for him? Selling. You should maximize or minimize? Maximize it. So, over. See there. Exercise, exercise, exercise. Okay na? Lapse, lapse. Exercise. Exercise or lapse. Exercise, exercise, lapse. Okay na? So we have done for whom? Call holder, put holder. What is the third one? Third one is a 4 marks exam question. This is correct way to ask the question. In real life market it happens this way. See here. See the screen once. What is the strike price? Sir, here I am a call holder, call writer in the third question. Third question I am a call holder, call writer. First see the question and tell. I am a call holder, call holder, put holder. First we should decide who we should be. That's a question. Okay? Tell me. At what price strike is getting traded? 100. Answer. 100 is the strike price getting traded. I am expecting the future price as how much? 120. Answer. 120. You are expecting a rise or fall? Rise to how much? 120. Answer. 120. So now tell me. SP is 100. AP is expected future price means AP. AP means how much? 120. 100 to 120. To exercise you should enter into which contract? Call option. SP is 100. AP is 120. To exercise this, into which option I should enter? Call, putta, call holding you should enter. Correct? So you should take a call option. You should take a call option. See. Later you can write. You should take which option? Call option. Really as per your expectation. Really as per your expectation. AB became 120. You will exercise a exercise. Understood? Randomly I will ask you. Tell me the sixth one. 152 is the SP. AP is 145 I am expecting. Really I am expecting. Expecting. Now I will enter into call option or put option to exercise. As per my expectation, I will enter into call option or put option. Answer. put option. Really price became how much? 148. I will exercise or lapse? Exercise. Now did you understand how to write the answer? Do that. I will not tell the answers. Do it. Think and answer all the remaining thing. I will lastly tell you the answer.
Sir, not even from holder's perspective, right?
Huh?
Only from holder's perspective.
Only from holder perspective. How to know whether this is a holder or a writer?
Strike price is
No, strike price will be there for both. Will you exercise? Who will exercise and lapse? Holder only will exercise. Anyway, writer won't exercise, na? Completed? Completed? Shall I proceed with the answer? See here. Second, 180, 160. Second one. 1 minute. Second one. 180, 160. 180, 160, I will enter into a put option and really it is 160, I will exercise. 100, 120, call option, 100 and 130, exercise. 135, 120, put option, 135, 137, lapse. 140, 175, call option, 135, 140, lapse. Okay, na? Next, 160, 185, call option, 160, 155, lapse. 115, 110, put option, 115, 105, exercise. 160, 180, call option, 160, 170, exercise. 175, 160, put option, 175, 180, lapse. That's all. If you understand these three, call option, put option, basics are completed with this. With this, we are stopping the today's session. Next session, we will continue with the payoff calculations. Okay, slowly we will complete this chapter. So no rush into the concepts. Hopefully everyone understood all the basics today clearly. Derivative basics. So options basics, once we understand clearly, remaining becomes very easy. Okay, but study and come to the tomorrow's session such that payoff concept will become easy. Introductory concepts everyone understood clearly. Okay, so then we'll meet again in the next session. We'll continue with the remaining problems. Okay, so thank you very much. Good night.